Swayam Prabha. Digital India. Educated India.
You can start, ma'am. We are live.
Okay, good evening, all of you. I am and faculty member at Binod Gupta School of Management, IIT Kharagpur. My teaching and research interests are predominantly in the area of financial accounting, corporate finance, financial markets, and derivative risk management. And I also teach and do research in commodity derivatives and risk management. And I believe all of you are enjoying the videos and the lecture materials which has been provided to you in the NPTEL platform. And I welcome any question that you may have till whatever videos you have seen, videos or lecture material. I'll appreciate if you can give these questions, and I'll definitely try my level best to answer these questions. Okay, so let me take one question which was posed in the Google group. So I think somebody had asked whether it is somebody can take commodity derivative trading as a full-time job. My answer to it is that yes, there are people who who earn their livelihood, make decent amount of profit by trading equity, commodities, foreign exchange derivatives, and spot market as well as derivative market. But I would rather exercise some caution. Instead of taking it as a full time, maybe you start trading on a daily basis, maybe an hour or two, see your expo, see whether you are able to sustain that kind of commitment in terms of sitting such long hours in terms of in front of computer and all. If that interests you and you are making decent amount of money, why not? In fact, we know the world's richest person, Mr. Warren Buffett, and in India, Mr. Rakesh Jhunjhunwala, they are well known for making money out of investment in different kinds of investment in stock market and stock and equity, bond, and other financial instruments. So this is definitely an option, one can explore. If there is any other question, I'll request Saurav to type it in the chat box.
Not yet, ma'am.
Okay, so if there is participants who are there, if they have some questions related to the quizzes which we have done, I believe Arunava, two quizzes are over.
Yes, ma'am.
Okay, so if they have some doubts related to the quiz questions, I'll also be very happy to answer those questions. In fact, all these questions which have been posed in the forum, I have tried my level best to answer this question on a daily basis. So not many questions have been posed. So I believe, the PPT and the lecture material is sufficient enough for students to, get their queries resolved. And still any other query, if any one of you have, I'll be very happy to take it over today.
One question is there from Mr. Nath.
Okay, yes, Mr. Nath, good afternoon. Are you able to hear me? Oh, I'm sure he will be, okay. His question, let me read out for everybody's benefit. Thanks for the answer. The question is, as a speculator, shall we need to take delivery for the commodities? Yes, it's a very good question. Please remember that when, commodities can be cash settled or settled through delivery. So if you are entered into a futures contract, which is a cash settled, there is no question of you giving delivery or taking delivery. However, if you have entered into a futures contract, which is compulsorily deliverable, so, for those contracts, 5 to 6 days before the contract maturity, the contract enters into a staggered delivery period. So if your futures contract are open when the staggered delivery period starts, that means you will be obligated to give delivery or take delivery. If you have taken a long futures position, you will be taking delivery of the underlying commodity. If you have taken short futures position, you will be obligated to give delivery of the underlying. However, if you don't want to take delivery or give delivery, it makes sense for you to close your position before the staggered delivery period starts, which is normally 4 to 5 days before the contract maturity. So if a contract maturity for a particular commodity is, let's say, 22nd of a month, normally staggered delivery will start from the 17th of the month. So you can square up your position, close your position before 17th. If you do so, then there is no question of delivery or taking delivery. I hope I have been able to answer the query satisfactorily. Is there any more question? Okay. Okay. How does one start trade in commodity derivative who is completely layman in this sort of a derivative? The fact that you are doing this particular subject will give you a substantial amount of knowledge about the commodity derivatives market. But I would, I would rather encourage you to start small. You can, you can open, I'm sure you must be having your demat account. You must be trading, equity, cash or equity derivatives. So if you go to your, the broker will have an option to provide you commodity derivative, platform, and you can start small and explore and then take it further. Unless, it's like a apprentice kind of a work unless somebody gets involved, actually goes to trade, no matter how much of theoretical training one takes, a person will not be, will not be able to understand how trading is done, what is a different kind of a margin, when to pay the margin, what are the intricacies, what are the profit, what are the loss, can never be understood unless somebody starts actually trading. So if you are interested, you can, open a demat account if you already don't have a demat account. But I believe the fact that you are asking me a question on commodity derivative, I believe, that means you must be experienced in the trading equity and equity related derivative contracts. And it's just an extension. The concepts are almost same. It's just an extension. Instead of index futures or index options, you will have commodity futures or commodity options here. You will be trading. Another question is option. I'll just take the question. Is options trading available? Are available in, yes. Please note that the videos which you are seeing, it was recorded in the year 2017. At that point in time, India in commodity derivative, options on commodities were not available. Subsequently, these are being introduced. In fact, I would encourage you to visit MCX or NCDEX website. When you go to the website, you will be able to see next to the product, in the product, you will have a futures and options, and you can see for which commodities you have options on commodities are available. A question is, if so, speculators are losing time value as they have to close their position before 4 or 5 days of the expiry. In case of option, no, please note that options normally have futures as underlying. So see, if you as a buyer of a option or buyer of a future, you are getting delivery. You are, I don't know from which part of India you are. You may be a student, or I don't know what is your profession, but all of a sudden you may be getting a delivery of, let's say, let's say copper is in some warehouse in near Bombay. So that means you now hold the spot commodity. So how do you sell that? Which platform you go to sell that commodity? So that becomes a very, very difficult proposition for a speculator to take ownership of the commodity. So that is why that is why the speculators ensure that they close their position before the futures enters into the staggered delivery period. Otherwise, if you don't do it, you may end up giving delivery. You may have to give delivery, or you may have to take delivery. And if you are, let's say, if you are a student trading options, trading futures, and you are asked to deliver, let's say, cotton seed, so those are other issues, difficulties come in. So speculators ensure their computers or their programs or the brokers, they have instructed their brokers to close their position well before the expiry, so that they don't get alerted with the underlying commodity. And once you have the underlying commodity in your name, you have an asset. But how do you sell that asset? You are not a value chain partner. You have nothing to do with, let's say, cotton seed. So you don't know whom to sell. So it will be it will be an added responsibility for you to identify a seller and sell it. So that's why if you are if you are a speculator, you don't you ensure that you don't get the delivery, or you are not asked to give delivery. Arunabha, am I audible what I am explaining?
Yes, ma'am. Yes, ma'am.
Okay. Is there any other query? Thank you, Professor Raman. In fact, I will share a little bit on how I started understanding more on commodity derivative. In fact, I was working on a book called Stock Exchange Investments and Derivatives, Straight Answers to 250 Nagging Questions. This book I co-authored with Professor V. Raghunathan of IIM Ahmedabad. When we were working on that particular book, commodity market, commodity derivative trading at India was at a very, very early stage. So we wanted to incorporate some aspect of commodity derivative into that book. But however, because of various reasons and paucity of time, we could not cover anything related to commodity derivatives in that particular book. So it was always there in back of my mind and I wanted to learn. So slowly, I started reading, and till date, there was no textbook on commodity derivative and nobody was teaching commodity derivative as a subject. So still, internet has been a great enabler, visiting MCX website, NCDEX website, and reading research papers and so on and so forth. I started offering this particular subject, commodity derivatives and risk management, as a subject, elective subject to MBA students of IIT Kharagpur. And 2017, I published a book with PHI India on the the title of the book is Commodity Derivatives and Risk Management, and this particular book also the Kindle version or soft copy version is available. If you are interested to read more on this particular topic, you may explore procuring a copy of this particular book. Thank you, Mr. Nath. It is very, very, I'm happy that, through my course, this particular course, you are able to learn and understand a new subject. In fact, this is the motive or motto of NPTEL, that through this online platform, we are able to reach out to wider audience and share our, understanding and share our, these new concepts. So, and this is a very, very emerging area. In fact, every day, two of my students are here, Arunabha and Nilotpal. Both of them are also working in commodity derivative. We keep discussing about the new developments, new happening, and new different types of products being traded at these commodity exchanges, different indices getting created, and it's quite interesting, and I immensely enjoy this particular subject, and I thought that through NPTEL I should share my knowledge with a wider audience. Yes, Professor Raman, the book is available at PHI, and the book title of the book is Commodity Derivatives and Risk Management, and I am the author, Praveena Rajiv. And in the forum, I will send a link to, to the book. I think it must be available in the Amazon also. If it is not available, I know there is a Kindle version of this particular book. I will share the link of this particular book in the forum after this live session.
There is a question about convenience yield. You can look into.
Okay. Okay. So, Mr. Nath, you always ask very interesting question also in the forum. So, how convenience yield is quantified? See, I'm sure you understand what is the difference between a nominal interest rate and a real interest rate. I'm taking an analogy of nominal real interest and real interest rate before I go to the actual discussion on convenience yield. In fact, when we make a fixed deposit in a bank will say, if you want to make a fixed deposit for 1 year, interest rate is going to be 5.15%. If you are going to make a fixed deposit for, let's say, a 2-year, interest rate is going to be 5.20%. So this interest rate, what we get to see is the nominal interest rate. And we know the relationship between nominal interest rate and real interest rate. So real interest rate is, in a very, very crude sense, we calculate real interest rate as a nominal interest rate minus the inflation rate. So similarly, in fact, we never get to see the real interest rate. If I ask what is the real interest rate, somebody will go find out what is the nominal interest rate. Somebody will go and find out what is the inflation rate. Nominal interest rate minus the nominal interest rate minus the inflation rate is going to give us the real interest rate. So real interest rate is always calculated. Similarly, convenience yield is always calculated. It is not directly observable. So we calculate the convenience yield by the difference between what should have been the theoretical price and what is the actual theoretical futures price and actual future price. And I think in week 2, there is a complete 2 to 3 slides exactly how the convenience yield is calculated. It's a simple calculation. Convenience yield is a return or a percentage term. And when we equate the theoretical price with the price, future price, which is prevailing currently at this point in time, we calculate a return, which is called a convenience yield. In fact, I can in the forum, I can exactly, provide you some, calculation of how convenience yield is actually quantified. Let me see if I can open my PPT and if I'm able to. Unfortunately, I'm not able to exactly locate which week PPT slide has convenience yield. Mr. Nath, yeah, Mr. Nath, I'll request you to.
Are you trying to share the screen, ma'am?
Yes, I thought I would share the screen, but unfortunately, I'm not getting the relevant PPT at this point in time. I will share that slide with in the forum.
Okay.
So we can move to the next question, where can you please tell me that, okay, the concept of hedging are not very easy, or the farmers are really benefiting out of commodity trading? See, I mean, it's a very, very pertinent question. Indian farmers are, they are not that financial savvy, and they don't have access to all this technology and all that. Having said that, at the individual level, individual farmers are not entering into commodity derivative, but you will be very glad to know that there are farmer producer organizations, FPOs. I don't know whether you have, ever got a chance to read little more about FPOs. So these are a group of farmers who are, joining hands together and creating a company. And these companies are known as farmer producer companies, FPCs or FPOs, that is farmer producer organizations. And now these farmer producer organizations are employing knowledgeable persons, or from some of the farmers who are little more IT savvy. They are coming to the exchange platform to mitigate the agri commodity price risk. I would again urge you to go to NCDEX platform to see, there are some case studies which are given how the farmer producer organizations are leveraging commodity derivative platform to mitigate the price risk. Of course, not many farmers are coming, or not many farmer producer organizations are coming, but a lot of effort is being given by government. Lot of effort is given by this, commodity exchange to educate these farmer producer organizations, to educate these farmer producer companies, so that they will be mitigating their commodity price risk by, in coming to the exchange platform. This is just a beginning, and I'm very, very hopeful the way, so much of impetus is being given by both these commodity exchanges, MCX and NCDEX, to bring farmers and other small traders, small players into the exchange platform. Very soon we'll be able to see a significant change. Okay, in session 7 folder, the commodity yield is there. Let me just check session 7. So I'm sorry, let me try one more time. I don't know why it's not. So let me, Saurav, if I upload a file in this box, will it be accessible to all participants at this point in time, or should I share it separately after the live session in the forum?
Ma'am, is the file uploaded in your drive, ma'am?
It is, I mean, you know, from my computer, I can directly take.
No, ma'am, you cannot share it. They are watching on YouTube now, ma'am. So you can share it in the course forum, ma'am, the link.
Yes. So, yes, Mr. Nath, I will be exactly sharing the material related to the convenience yield. In fact, in my in my backup, it is there. Exact calculation is there in the session. It is there in session 8 PPT. I can exactly name the PPT. That is the point, PPT number 13 in session 8, which shows a convenience yield calculation, which compares the actual future price vis-a-vis the theoretical future price. And from there, how are we calculating the convenience yield? Is there any other question? So, considering that there is not. Okay, thank you, Mr. Nath. And I will, as I said, I will also, share the same slide with you in the forum. So if there are not many questions, maybe another couple of minutes, we can, wind up this particular session. Saurav?
Yes, ma'am.
I think, there is not many There's no other questions, so I think I would like to close the session at this point in time.
Sure, ma'am. Just wait for a couple of minutes, ma'am.
Okay.